Good morning, folks, and welcome to Swing Trading Today. This is Bob Desmond, and it is Monday, January the 7th, 2019, 5 a.m. in the morning, Eastern Standard Time. Let's begin with a chart I began talking about last week, and I didn't check it until last night after all my commentaries were completed. I completed the week ahead commentary for members. Members, if you haven't watched it, it's posted in the members area. And the chart that I revisited was Berkshire Hathaway. And I sent out a message in the forum on Thursday evening that there was something wrong over at Berkshire. The weekly chart was looking very ominous. And I had expected, because I didn't check it until, again, last night, I expected that we would have rallied back off the lows as we did with the S&P 500. Let's pull that up here really quick. Weekly chart. S&P 500 bullish key reversal on the week, back to Berkshire. Okay, so you can see there's a stark difference between the S&P 500 on a weekly basis and the shares of Berkshire, which only closed slightly off the lows of the week. And honestly, this is an ominous candlestick because it appears as though we, in all probability, will continue to put in lower lows. So the question then becomes, what's the problem over at Berkshire? The problem is that the fund, it looks as though Warren Buffett got himself in a little bit of trouble here. He's overweight of Apple. The fund, as of October 2018, that's the most recent data I could find, had 23% of its holdings in Apple. Does this candlestick look familiar to you? It looks very similar to what we saw on the Berkshire A shares. So while yesterday I was fairly upbeat with members that, you know what, we may just have the beginnings of a continuation move higher this coming week, last night I became a little bit cautious, and I want to dial back my optimism a bit, because if Apple goes, if Berkshire goes, and they begin to break down to new weekly lows, these are two of the most widely watched stocks / a fund in the case of Berkshire out there. And if they begin to break down, it could certainly hamper sentiment in the markets. So a warning flag is on the track for Apple, Berkshire, and if they go, be careful of this entire market, because remember why Apple fell. It fell because they reduced their Q1 2019 revenue guidance. That gives license to every company out there, because Apple did it, to come out and lower expectations as well, and they will blame China. Let's get on to the pre-market activity. Okay, let's kick the pre-market activity off with a 4-hour chart of the S&P 500. These will all be 4-hour charts. And what we're seeing here is a inverted head and shoulders setup. Left shoulder, head, right shoulder forming. In fact, we broke out above the neckline on Friday. Now we're pulling back a bit. We're down slightly on the morning, and it looks as though we're going to retest the breakout point. We do have a small short position on the Russell 2000. We may have to stop out of that trade today. So what we're looking for here on the S&P 500 is a continuation move higher. That'll tell us whether or not this rally is for real. If we begin to break out and above this upper band of resistance, well then, it is game on. Now, if we fail to hold this current green, now going to red, support level, and we close down below it today, that's a problem for this market. So these are our early warning signals for the market. If we get a breakout above this upper band of resistance, it's game on to the long side. If we get a breakdown and we close down below the support level here, we have big problems for the S&P 500. Let's go to the NASDAQ. All right, so the NASDAQ is setting up very similar to the S&P 500. Here's your left shoulder. Here's your head. Here's your right shoulder. We broke out above the neckline. We had a nice trading range, this trading channel. When I logged on a little while ago, we were flirting with this support level, but this bar just opened up literally 10 minutes ago, this 4-hour bar, a lot more time to go. But again, much as what we're seeing on the S&P 500, we're seeing here on the NASDAQ. And our strategy is very much the same. What we're looking for is a signal by the market as to whether or not Friday's rally was for real. Was it a short squeeze? Or in the end, will the market succumb to earnings concerns which were kicked off by Apple last week and which forced the Federal Reserve to blink on Friday with their dovish comments? So we're keeping it really, really simple. Do we break out or do we break down? Simple as that. Let's take a look at the US dollar. Now, the dollar is really beginning to deteriorate now. We did break down last week. We did get a short squeeze. I said that it was a short squeeze. There was no reason for the dollar to be rallying. And sure enough, we have come almost full circle on the US dollar. This is a rounding top on the dollar. This support level here at the 96.20 level was critical support. So much so that they orchestrated a short squeeze, rallying it back up above that level. They pulled it back. It tried to consolidate and hold. In the end, after an attempted rally, it failed. And now we are back down below. So what we have here is a big bull trap or a breakout point failure. So what are we looking for? And what will we do? And why is it important to us? What we're looking for is a breakdown on price, a continuation move lower. If we break down and close below 95.64, it's all over for the dollar. We're going a lot lower. What will tell us whether or not the dollar will make that move lower? You just need to take a look at the other two major reserve currencies. The yen, which spiked higher on a short squeeze last week. I went over this chart. As a matter of fact, it's one of our member stock chart requests this morning, the FXY. I'll play that for you in a little while, so stay tuned. So here's the yen, a major move higher last week. Last night, we broke out above resistance yet again. So the yen is looking strong. Now the euro, which I expressed concern with to members last night, shot up higher on the 3rd, but it reversed and rolled over. I am not as bullish on the euro yet as I am on the yen. And the reason is that the Europeans, and you don't hear much about it on the financial news media or the mainstream media here in the United States, because for all intents and purposes, they don't want to talk about the massive political unrest going on over in France in particular. The Yellow Vest movement. I'm not going to get into details with regard to politics right now, but it is a major movement. It is spreading, and it's probably coming to a country near you. So that political unrest is not good. However, if the markets shrug off the political unrest and the euro moves higher along with the yen, you can expect major league weakness in the US dollar. As far as I'm concerned, the only thing keeping the dollar up right now is the weakness or the lack of follow-through on the euro dollar. One of our members posted in the forum, they wanted me to take a look at Bitcoin. It's been a little over a week since I looked at it. This is looking really, really good. 4-hour chart, Bitcoin. I have some smart members. Inverted head and shoulders setup. Left shoulder, head, right shoulder. Here's what we will call our neckline. We're not there yet. Right here. At just shy of 4,200. Now, we're a bit overbought, quote unquote overbought, relative to the 3rd standard deviation Bollinger Band in red. And technically, we're not supposed to be there. We'll probably pull back some. If you wanted to nibble, that's fine. But if we rally up and through, let's call it 41.54 on Bitcoin, and we close there, it's probably going to be game on to the long side for Bitcoin, and we'll probably go up to around the 47.50 range. Pardon me, my voice is going again. We had a nice breakout on RSI, so it's looking good. So we're beginning to see signs of a base form on Bitcoin. I'm liking it. especially on a rally up and through resistance. Now let's take a look at dollar sensitive plays. Gold in particular. It pulled back on Friday along with the miners. And we are this morning rallying back. We were up a little bit higher. We tapped the 1300 level last week and then we backed off. That was widely expected. And I would probably expect it again if we rally up into 1300 to 1310. If we close above 1310, I think that you're going to see some institutional accumulation of the GLD and the GDX, which is the gold mining ETF. Now, I will caution, we did break down below the lower band of support on price, but let's remember, this is only a 4-hour chart, and this move higher, it was overdue. We needed a pullback. We got the pullback. RSI rolled over. We are rallying back. We attempted to take out prior support, which is now resistance. We're rolling over a bit here. So would I go buying right now? Probably not. I'm still very bullish on gold, but ideally to add more, either we break out or we pull back, begin to base yet again, and then on a breakout of that base, using a either 2-hour chart or a 4-hour chart, I would look to get long. Again, sorry folks, my voice is going. Crude oil prices, of which we are now long. We opened up a position last week on crude, and we are moving higher. We may just look, because we bought a leveraged ETF, we may look to book some profits on that position. We're leaning into the third standard deviation Bollinger Band. This is a really nice rally. We could very well rally up and into resistance up here at the 50.39 level. And if the dollar breaks, as I'm predicting that it will, that will only help the odds of crude oil prices rallying up and into resistance. So crude oil looking good this morning. Let's leave off with the 10-year Treasury note, not the yield, but the note. It is up this morning. It sold off and sold off hard on Friday. It was overbought. Now we're attempting to consolidate. We did break down below the lower band of support. We're back above it, and we closed above it as well this morning. So the question is, do we rally or do we roll over and put in a lower high and a lower low? If we fail to hold the support level and we move lower, that means that yields are moving higher. Folks, now let's segue over and into our member stock chart requests. This is where I review the symbols that our gold members submit for me to review on video. Hey folks, thanks so much for watching, and we're going to begin again in just a moment. But first, I wanted to make a really big announcement. I'm really excited about it, and I think you're going to like it too. And the announcement is this. I am going to be raffling off a 1-year gold level membership to the Contrarian Trader. That's right. Trade alerts, daily commentary, paper trading simulator, access to the members forum. And I will be announcing the winner on January the 5th, 2019. All you need to do is pause this video, click the subscribe button, click the like button, and you're in. That's it. So don't wait. Enter now. I'll say thank you in advance, and let's get back to the rest of the commentary. Okay, folks, let's segue over and into member stock chart requests, which is where we review the symbols that our members submit for me to review on video. So let's begin with the EMLC, which is the Van Eck Vectors JP Morgan EMC Local Currency Bond ETF. Woo, that's a mouthful. All right, so this is a weekly chart. You can see that we had a nice consolidation through September. Then we began to break out. Then as we hit resistance, beginning in, let's call it November last week, we finally broke through and broke through convincingly. It was an abbreviated week. Volume could have been better though. An abbreviated week, we'll chalk it up to that. It did rise over the prior week, which is bullish. Stokes are rising above 50, good stuff. Above 80, good stuff. RSI rising above 50, very good. Daily chart. Now on a daily basis, we cleared the 200 period moving average on Friday. The problem here is that we're leaning up and into the third standard deviation Bollinger Band in red. Can it go higher? Sure. It's not going to stay there. You're going to get a pullback fairly soon, or at least a stalling and consolidation for a couple of days to alleviate that quote-unquote overbought condition, again, relative to the third standard deviation Bollinger Band. So that's a good thing. Volume is rising sequentially. The next chart up is the FXY, which is the yen ETF, bull ETF. We're using a monthly chart here because there has been a lot of technical damage done. And most recently, after entering into a consolidation range, which lasted for a couple of years, we broke down below the lower band of support back in September. We found a base and we have since rallied back. We recaptured resistance, now support yet again. We were rejected at the upper band of resistance on the monthly chart. We're looking for a breakout here. So while I think that you could buy the FXY where we're at right now, you need to use a stop right below the month's lows and get out, because if we close back down below this lower band of support, we'll probably come back down and retest 83.54 and could quite very well head lower. Daily chart, you can see that this is a massive short squeeze. And where we hit last week in terms of highs at 89.13 was prior support back in February, March, and then again in April. So what was support is now resistance, and that's a natural thing. Volume on Friday was very high. So we could pull back here, possibly to fill this gap that opened up on the 3rd. But I think that the yen longer term is firming up. It's beginning to take shape as a potential long trade. I mean, the Federal Reserve, while they may have thrown the markets a bone last week in terms of dovish commentary going into 2019, the jobs data shows that the economy is growing, that there will be wage inflation, and that the Federal Reserve is willing to go behind the curve and let inflation run. What will do well in that environment? You want to look towards the yen and the euro. The euro I'm a little bit skeptical about because of their political unrest in the streets of France right now, and it's actually spreading. I don't want to diverge into a political commentary here, but the euro is shaping up and looking good. Some oil stocks, weekly chart, TNK, we're taking a higher level view here. We had, on many of these, an undercut double bottom, meaning we found a low back in October, September, August. We held there for quite a while. Then what do we do? In December, we broke support, only to reverse and now rally back to recapture. That's an undercut double bottom. Now, can these shares be bought? You could nibble, but I would use a stop right back down below, 94 cents per share. I would look to add more on a breakout and a close above 1.25 per share, which will act as the pivot point for what is shaping up to be an odd-shaped W formation. So TNK, longer term, looking good, but these will all be longer term plays. They all had good weeks last week, daily chart, but you can see they kind of get ahead of themselves, right? These are short squeezes. So just be careful. I would not focus on the daily charts for these names. I would focus on the weekly charts, the monthly charts. Look for those macro breakouts because there's been a lot of damage done here technically. So I would stay very high level, weekly charts and monthly charts. Scorpio Tankers, weekly chart. Another one where we are in a consolidation. We did bottom out back in April. What did we do? As recently as October, we broke down below critical support. We have now rallied back, so we're showing signs of strength here. We're stabilizing. There's no reason, though, to go running in and buying these shares because we are not that far away from critical resistance. And as it stands right now, while we have stopped going down, we have yet to begin to put in higher highs. No breakout yet on RSI, but it is putting in higher lows and higher highs. We need to see a breakout and a close above 50. Stokes, they're beginning to hook up here, but you have the potential for a head and shoulders setup. Left shoulder, head, right shoulder. Here's your neckline. I don't think that this will follow through to the downside, though. Volume last week was good. Ultimate oscillator, rising. Overseas ship holding. Weekly chart. Another one where we had bottomed out back in February. We undercut the February lows in December, and now we have broken out above the upper band of resistance. That's fairly bullish stuff. But volume dropped off last week, and yes, it was an abbreviated week, but so was the prior week. Ideally, on a breakout, you get rising up volume. So what I like to see here is a pullback and a retest of this 1.67 level. Might we rally up to $2 per share, $1.90 per share? Sure, that could happen, but I think ultimately we're going to get a pullback and a retest of this support level. So I don't see a major reason to go running in and buying these shares on Monday morning. RIG. This is a monthly chart. Again, I want to take a look at these charts from different perspectives. Now, another case where we had bottomed out back here in August of 17, rallied, pulled back. We undercut that low. What do? In January, so far, the month isn't over yet, we have rallied back to recapture prior support yet again. We must hold $7.20. If we pull back off the month's highs and close back down below 720, you need to avoid this stock like the plague. I don't like the fact that the Stokes are declining, but perhaps they'll begin to catch a bid. They'll begin to bottom out and hook back up yet again. Historically, Stokes have a V-shape recovery on RIG, so I don't know how much I'd read into the Stokes here. Weekly chart, a nice bullish reversal week last week. We could rally up to $8 to $8.50 per share, but look for a pullback. You want to get a pullback to a higher low or a retest of recent lows. That's the better risk-reward entry point. Do I think that we may have a bottom here? Sure. But again, we must close out the month above $7.20. If we don't, I would be out. Diamond Offshore, monthly chart, a bullish key reversal month so far, but the month is still young, right? So what we need to hope for is that we get a pullback and a retest of this breakout point. It may not even be this month. It could be next month. Could we see a continuation move higher? Sure. But keep in mind, we've already rallied 14.41% on the month so far. And again, a lot of technical damage has been done here. Let's take a look at the weekly chart. It looks good. We closed at the highs of the week. We closed above this support level. If you bought it, you have to use a stop right below 10.06. If we rally, I think we could rally up to 13.10 per share. But I think from a longer term perspective, if you're looking at this as an investment, you'd want to allow the rally to run, wait for a pullback, get that higher low, and then begin to build a position. If you want to nibble now, put some risk on, yeah, go for it. Keep it small. But ultimately, we're going to retest, just like we did back here. Think about it. Back here in June of 17, we bottomed, rallied to a pivot point in July, pulled back, and retested in August. And then it was off to the races. I can completely see that happening yet again. Volume last week rose to above average, very impressive for an abbreviated week. Ultimate Oscillator broke out. Daily chart. Now on a daily basis, we closed above the 20-period moving average, which is good stuff. Just keep in mind, if you put a trade on here, we have resistance right above at 10.92 per share. Stokes are rising, RSI is rising. Volume, very good. So we have some institutional accumulation here of Diamond Offshore. Next chart up, ESV, Ensco PLC. Another one where we broke support. Last week we reversed to recapture the $4 per share level. 405 is actual support. So the chart is looking good. Do I think it's a straight shot higher from here? I doubt it. I think that we'll probably bob around here, retest the $4 per share level. Traders will want to know that that support level is for real. Volume rose last week versus the prior week, which was good. Daily chart, we rallied up and through the 20-period moving average. We've come a long way in a very short amount of time here. So the easy money has been made. I would wait for that pullback, allow for it to pull back and retest support. Advanced Micro Devices looking very good. This is a weekly chart. We had if anybody ever wonders, what is he talking about with regard to a retest? We had a retest of the breakout point last week. What's the breakout point? Well, the week of December the 24th, we broke out. Then we pulled back, tapped it to retest to ensure that it would not fail as a support level. And what did we do? We reversed to close off the lows of the week to close at the highs of the week. Very bullish stuff. AMD is looking very good. Volume rose versus the prior week. Daily chart, we closed right at resistance. I'd like to see it close above $19 per share. We closed right at it. The 50-period moving average is declining. That's acting as a declining ceiling and threatening to take out the 200-period moving average. So that may keep some of the technicians on the sidelines. Volume was very good on Friday. Stokes are rising, RSI is rising. So the chart is looking good here for AMD. And that is it for today, folks. Everybody have a profitable trading day, and I'll talk to you soon. Hey, folks, just a really quick thank you for watching this far into the video. I appreciate it so much. And a quick reminder, don't forget about our one-year gold membership raffle. That's a $1,164 value. And all you need to do is just click the subscribe button, click the like button, and you're entered. That's it. And we'll announce the winner on January the 5th, 2019. I'll see you there. Let's get back to my commentary. And if you have any questions, leave a comment below.